Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, welcome to the show. Phil Tarrant here. I am the editor of Smart Property Investment. Thanks for tuning in. It's always good to have you listening to the show and hopefully improving your knowledge around property investment. That's what we're all about. Today I'm joined by my regular co-host Vivian Kelly. Do I always call you Viv or Vivian?
You do always call me Viv. That's why you stumbled on my full name. I don't think you've used it for 5 years.
You're all right with Viv. I've never asked you. It's okay.
I am.
Yeah,
After 5 years, Phil, I'll let you get away with it.
Nice one. Thanks, Viv. Always good to have you on the show. Today's guest, Michael Ossett, who is a property investor. So he's emailed in a little while ago and Vivian sort of got back to him. He's a long-time listener, first-time podcaster.
That's right.
Is that good?
Yeah.
Yeah, there we go. Yeah, thanks for coming on, mate.
No, pleasure. Good to be here.
Now, I was going to ask you this off air, but I didn't. Can I detect a slight twang to your accent?
There's a bit of an English accent
English
there.
accent.
Yeah, Northern England.
You've been here a while, though, haven't you?
Yeah, it's probably about 10, 11 years now.
Okay, so it's softened quite a lot.
Yeah.
Yeah?
Yeah, there's a bit of a twang.
Michael's one of those classic, came to Australia for a year with sort of $2,000 with his girlfriend, I think, and 10 years later, he's still here.
Still here. Can't get rid of me.
Backpacker. That's cool. So you arrived in Sydney 10 odd years ago, just stumbling your way around the world as you do, and then landed in Sydney.
Yeah.
And then what happened?
Well, landed in Sydney, thought we'd give it a go, get a bit of work and then travel for a few months, maybe try out a few different cities. And the plan was to go back after 12 months. That's what we'd told all the friends and family back in the UK. Yeah, landed in Sydney and both of us fortunately got a couple of jobs fairly soon. Loved the city and got settled down and ended up turning that into full-time permanent jobs.
Yeah.
And still here now.
So what sort of work do you do?
So I work in commercial and industrial property.
Okay.
So I'm a design manager within that.
Design manager?
Yeah, so kind of
what
like
does
an
that do?
architect. Look after the architectural side.
So when someone builds a big, like a commercial building or an office or retail or whatever,
warehouse,
you're the guy that sort of says this is what it should look like.
Yeah,
Okay.
we look after the design process and engage a few external architects to do that for us. So
That's pretty cool.
Yeah, it's quite interesting. Very different to residential.
Yeah, so talk me through the journey from being a backpacker to residential property investor.
Yeah, so I suppose once we'd been here a while, we kind of knew we wanted to put down roots and I've always been a fan of property, worked in construction previously and so always been around it. And we, I suppose, had that passion to get into the market and get established. So the first property we bought was our principal place of residence.
So you keep saying we. Is this the girl that you're travelling with?
That's right, yeah.
Okay.
So girlfriend at the time, now
good.
wife,
Yeah.
and mother of our 1-year-old daughter.
Excellent.
So we're a bit of a pair now, bit of
Are
a
you
team.
Aussie citizens yet?
Yes, we are, yeah. So
Cool.
we got that back in 2011.
Nice. So first property, principal place of residence?
Yeah, so we got a unit. So we, saved hard first few years, and we always knew we wanted to buy somewhere eventually. So saved and bought our first place, which was a 2-bed unit in Manlyvale.
Okay.
So we'd been renting on the lower North Shore and really liked the area, but we knew we could never afford to live there. So took a compromise, moved a bit further out, lived there for 3 years.
Okay.
And then, I suppose it was during that period that the sort of passion for investment came into it, and decided to use some of our savings to try and get another property to rent out.
Okay.
And really loved Manlyvale. It's kind of a bit of a strange suburb. It had that stigma previously.
Can you walk from Manlyvale to Manly Beach pretty easily?
Yeah,
Yes.
in
How
about 15
far?
minutes.
Okay.
And it's
Not
flat,
too far.
so it's
Not that massive hill up Sydney Road or whatever?
No,
Okay.
no. So that was the thing about it. It had this stigma from a long time ago, but it was a growing suburb, new cafes, shops and restaurants going in, but so close to Manly.
So you bought a principal place of residence. So I want to fast forward really quickly. How many properties do you have now?
We've got six
properties
now.
Okay, so we've got to fill in 5 there. So
Yeah, there's a few.
PPR.
Yep.
And then you bought another place.
Yep, that's right.
Okay.
So we actually bought another place in Manlyvale. So in hindsight, it was kind of one of those things that people make the mistake of now, buying an investment in their backyard because they know it well. But I think the fundamentals were still there when we did the research and decided to do it. It's still a growing suburb with great potential. And it's one of those areas that was kind of the poor cousin of the suburbs around. So you got Balgowlah, and Manly itself, Fairlight, and Manlyvale was always that bit cheaper. It's probably caught up.
Was that another 2-bed apartment?
It was, yeah. It was a 2-bed. It was a much older building. And
like a red brick type thing?
Original condition.
Okay.
And it was on the market for about 6 months before we bought it. And I'd been keeping an eye on it. And I suppose that's why we bought it, because we'd been looking at it for so long. And the price was dropped every month.
Were you able to leverage off the fact that it had been on the market for so long to sort of get that price down?
Yeah, I mean, I went to a few of the inspections, and there was other people looking that looked like first home buyers, but they walked in and walked straight out again.
So what? A couple of things. What did you pay for your principal place of residence the first time
back
around?
then we paid $568.
$568. Okay, and then this next property, 2 bedrooms, different sort of block, same suburb.
Yep.
3.5, 4 years.
Yeah, 378.
Okay, and what were they marketing it at when you first saw it?
They were asking 440 originally. Yeah.
Okay, so that's dropped by like a lot of money, like 70, 60K.
Yeah.
Do you think the property was overpriced or poorly marketed, or what do you think was the problem?
Both. Yeah, overpriced, too high an expectation, and really bad marketing. Photos looked like they'd been taken with a BlackBerry. And then condition as well. It was, original condition. It was full of furniture. It was smelly, and
sounds like great property.
Yeah. Well, from an investment perspective and a potential,
it also sounds like the real estate agent didn't do a very good job.
Didn't try very hard. Now,
did you see? Did it change real estate agents, the property, when the price was coming down? Did you?
No,
notice?
they stuck with the same guys.
I won't ask who it is because I don't want to give them a hard time. But I think it's a really good point that you make. It's when you see a property languishing on the market for so long, you need to ask the question why. And one of the reasons why, and this we talk about all the time, is that it could just be a very bad real estate agent who hasn't been able to manage the expectations of the vendor, and they've gone, I think my property's worth $440,000, and the real estate agents go, I really want the listing. I think it's worth that much as well, and then it ends up selling at 378. So that's sometimes one thing. But the other side of what you said is that it's really poorly marketed, and it's a product also of perhaps the real estate agent hasn't done a great job, but bad photos, not well presented either. So smelly, heaps of furniture. Yes, it sounds like so much more could have been done for those guys to get a higher price. But on the other side, as a property investor, these things are gold mines, they're gems. So how did you end up buying this property? Did you just say give a silly offer and they took it?
We went in pretty low. I mean, we started about 360s and went up from there, and managed to obviously bring them down a long way. So I think when we started offering, they were still asking 390 to 400 for it. And there was obviously no other interest there at the time. As I say, the condition of it was bad, but we kind of, just ignored all of that. And coming from a design background, I could see past the crap that was in there.
Yeah, I was going to ask that, Michael. How could you tell that it was just sort of, you said it smelt bad and it looked bad. How could you tell that they were just kind of cosmetic issues, not actual deeper, real problems?
Yeah, so I mean, you could just see past the furniture, the carpet, the paint, the horrible vermiculite ceilings, and I knew a couple of other units in the same block had been renovated previously, so I'd seen what they'd done. And the potential was there. So I walked in, I said, this is great potential. My wife walked in and she wanted to walk straight out again. She said, there's no way we're buying this.
So what'd you do to it? So you picked it up for 378, did you?
Yeah, and then we basically gutted it and then did a full reno on it in 3 weeks and got it rented out on the 4th week. So really quick turnaround.
So what rent did you end up getting for it?
Originally we got $450 a week. So it's quite a good, obviously a good yield to begin with, and that was based on the renovation.
Yeah, and did you get it revalued pretty soon afterwards?
About a year afterwards.
What did it come in at?
I think then it was low 400s.
Okay.
So we got a bit of an uplift straight away.
That's good. And today, you still got it?
Yeah, still got it today. It's been the best performing property.
Yeah.
And it's about $650 today.
Okay, it's not bad. And it's yielding pretty well then? Your rent's gone up?
Yeah, rent's gone up to 40 now.
Okay.
So yeah, so doing well.
So how'd you go from number 2 to number 3, which is often the hardest? So you're still in your principal place of residence?
That was our first one.
Yeah.
And then 3 years ago, we sold that first PPR to be able to buy into a bigger property. We'd outgrown that. New family was kind of on the cards. So we sold that unit and bought up the road in French's Forest.
Okay.
So we got a house up there.
Like it was a family home, wasn't it?
Yeah. And we, I suppose, had the investment hat on when buying that. So it had 2 incomes in there already.
Okay.
So it was a split house with 2 separate tenants in. And we bought that, moved in upstairs and kept the tenant downstairs. So from a cash flow perspective,
good.
That helped pay for the mortgage.
Yeah.
And so we bought that in 2013.
And what did you end up paying for it?
We got that for $920.
$920. It's really interesting. So you sold your PPR and then bought this place. Like, was there a big transition between selling and buying?
No, we did it within about 2 weeks. So
Okay.
it was coming up to Christmas, and we'd just got married. We got back from honeymoon. So well, what do we do now? We've been planning a wedding and a honeymoon for 12 months.
Yeah.
So I said, let's go and look at property.
I mean, the expense of a wedding and a honeymoon can often set people's investment journeys back by years. How did you do that so quickly from getting married, coming back from a honeymoon? It's approaching Christmas time, which is an expensive time of year. How did you have the money ready to sort of upgrade?
We had a good cash buffer there already, so we'd continued to save. We've always lived quite modestly and always been keen to save money and not live on the line. And I suppose that passion to step up in the market was there when we got back, and the market was fairly buoyant then at the end of 2013. And we spoke to a couple of real estate agents, and they gave us a really good price expectation for our unit.
Okay.
And we thought, well, if we can get that for that, we can move up and use the equity that's in there to fund the deposit on the next one. So although it was a bit of a jump, it wasn't out of reach.
So your PPR was principal and interest, so you've been paying off.
Yeah.
Were you paying extra into it as well?
Yep.
Okay.
Yep.
So you manufactured some equity as well as getting the realisation of price growth, which is good. But I think you made a really good point when you said that you approached the purchasing of your new PPR, principal place of residence, from the objective as an investor rather than as an emotional. So obviously it was a place that you wanted to live in. That's a good thing. But the fact that it had dual income as well, which is a really smart way to approach it. So do you still have this place now?
Yeah.
Do you
So
still
we're
live there?
now?
You
Yes,
still
I still live
and you
there
still
now.
have someone downstairs?
Yep.
Paying? Great.
Yeah.
So as a percentage of the total mortgage on that property, what do you think your tenant pays?
Probably about half of it.
That's pretty good. Okay. And that empowers you then to use the cash you're generating to buy other properties. Okay. So let's talk about property 4 and 5. What sort of happened after that?
So I suppose the market did really well in Sydney in the last 3 years, and I was keen to get another property as an investment. My wife was probably less keen. She needed sort of bringing along a little bit and say, because I knew property was a great tool to build wealth and create a passive income down the track. So I was really keen to go again, and we I suppose we got a bit of mentoring to try and push us along that next step.
Okay, where'd that come from?
So we went to see Destiny.
Okay.
Margaret Lomas.
Okay.
And
Margaret's a big friend of our show. She's a good operator, Margaret.
And those guys were great.
So did you do one of her courses?
Yeah, we did. Yeah, I mean the fundamentals in that. I pretty much understood all of it, but it was great to get my wife on board. And after she'd done the course and realised the potential, she came out of that and said, right,
let's do it.
Let's do it.
It's really funny you say that because we chat to investors all the time, and in many instances, you've got someone who's very bullish in a relationship versus someone who's very conservative. So you have a person saying no, 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 and there's someone saying go, go, go. And it happens a lot, more often than you expect. And, your experience you explained as in you went down the education path and gave your wife the confidence outside of you just going, we've got to do this because it's great. To hear it from someone else sometimes is a really powerful thing, because then it empowers that person to make the decision themselves rather than thinking that their wife or husband has sort of pushed them into something. So
Yep.
it's a good way to do that.
Yeah,
and
and
I've heard other people go that.
I think it's important as well. I think it's important for both, people to be on the same page. It's no good one person wanting to do something and the other person not wanting to do it. So I think you've both got to make that decision jointly.
Yeah.
So it's good to do that and do the education component, and then the mentoring to really push you to that next level.
So how's mentoring work? So you've done the course, and a byproduct of that was that it empowered your wife to actually go, yes, I want to do this. But what else did you take from that course that was the real one thing that made you go, this is how we're going to do it, or let's not do it this way anymore, well, let's do it this way? What was that?
I think it was the goal setting.
Okay.
And basically working out from, the equity projections and the cash flow projections, what you could actually achieve by buying and holding on to property for the long term. And I think it was that hand holding through that process that really made the picture clear. So we came out of that with a 15-year plan, and with a projection, to replace our salary with a passive income. And that's really been the driving force to take the portfolio forward.
Okay. And a lot of people, I don't know how much Margaret's courses are, but I know you pay for them. How did you overcome the idea of spending money on education versus spending money on just investing in property? And a lot of people are hesitant to invest in property, and invest in education and property. One of the reasons why is that there are so many free seminars or courses available around property, and you go to most of those things and someone's going to flog you a property, right, rather than educate you. Was that ever a hindrance for you, thinking, I've got to pay for this money to give it to someone else for them to help me be a better property investor? Was that an easy decision?
Yeah, there was a bit of hesitancy there from a cost perspective, but the way that we looked at it was the potential return we could get from a property in the 1 or 2 years afterwards far outweighed the cost of doing the education.
Did you do an Excel spreadsheet and try and work that out in a logical way?
Yeah, absolutely.
Okay. Is that the way you're sort of wired?
Yeah, very analytical, and so once you got a clear picture of that, it made it made better sense to get the education and then take it from there.
And the investment obviously is paid off for you.
Absolutely. Yeah.
That's good. It's good to hear. It's funny how many times people get burned investing in property. There is some people around historically who have taken people for a lot of money in terms of property education. They just end up getting sold an off the plan apartment. So,
Yeah, and I think that makes people hesitant to spend money on education, which can sort of be a double-edged sword. They don't want to spend because they don't want to get ripped off, but then they don't spend and then they don't really know what they're doing. So I think it's about finding someone who is a good operator in the industry so that they can educate you and you don't get ripped off, but then you know what you're doing. Michael mentioned he's come out with a 15-year plan and knows what sort of passive income he wants to have, knows when he wants to replace his existing income. So that sounds sort of pretty solid and like you've got a pretty good plan moving forward.
What would be your tips for our listeners around that decision you had to make around investing in property, education, or even as investing in buyer's agency or whatever, however you choose to pay for advice? What would be your tips for our listeners for them to understand the best way to do that?
I think you need to decide what it is that you want. You need to set your goals up first, and then work out how you're going to get to that goal. So if you're a proactive person and you want to take 100% control of the investment of the portfolio, then I think that avenue that we took is fantastic, because you get the education, the knowledge to begin with, and the tools to set you off, and you go off and do it yourself with someone holding your hand along the way. I think for someone who might be time poor, wants to understand but doesn't want to do all the legwork, I think a buyer's agent is obviously a great way to go and to pay for that professional advice and to someone to hold your hand that way. But I think just taking the step to do it, and there's always a bit of hesitation there, but I think you've got to make the jump and actually
just go and do
go for it. Yeah.
So you bought your principal place residence / investment property.
Yeah.
And then you did your education.
That's right.
So so that helped framed your strategy moving forward, because you had some long-term goals in terms of replacing income with property investment, etc. So what happened after that? So your properties post your education?
Yeah, so we realised that we'd built up a bit of equity in the house only after 2 yees of owning it. So as the Sydney market has gone so well, and we took that ride. So we knew we had that equity that was accessible. So we spoke with a broker, managed to get at that equity, pulled it out, and then use that for the deposit and the costs on the next 4 properties. Basically.
Okay, so did you go?
We went
Well,
1,
you
2,
went big.
3.
Yeah, 1, 2, 3.
Yeah, in one hit.
Yeah.
And as part of our plan, the idea was that we might be able to get to that 4th within the first 12 months, maybe the next year after. And I think it was having that plan in place that really pushed us forward to get that next one.
So it crystallised your goal setting. So that's 4 properties. 3 properties. How quickly was that? Like month?
Within about 4 months.
That was within 4 months.
So May and then 2 in August.
Okay, and then the one after that was the year after.
At the end of the year, December, January.
Okay, and you managed to make a kid in that period as well.
Afterwards,
After
yeah,
that, okay.
yeah.
So you got this
Get
done
the property first, and then the
off
child
first.
afterwards. Yeah.
That's cool. So properties. So those 3 quick consecutive ones. Where were they? Where were the properties?
So the first one was up near Ipswich.
Okay.
Up near Redbank Plains.
Yep.
And the second one was in the Moreton Bay area of Rothwell. So 2 areas that we really did the research on and targeted that infrastructure investment, population growth, all those drivers that I suppose Margaret teaches people.
Yep.
But all those fundamentals that you've got to follow before you make a decision to buy in an area. And bought those for the first one was 300,000 and the second one was 390. Both yielding above 5%.
Good. And then the one after that?
So the two after that, the next one was in Adelaide. So the northern Adelaide suburbs. So a less favourable area with some people. I suppose from an employment perspective, they're not doing great right now. But there's other drivers there in terms of infrastructure and town upgrades. And that was a bit more of a long-term sort of development play.
Okay.
So there's a bigger block with an older house on it that's got the potential to knock down and build a couple of townhouses down the track.
So you're starting a little bit more sophisticated in the type of properties that you're looking for. So stuff that you can add value to through, subdivisions or granny flats, etc. Okay, good. And then the last.
And the last one we got that was south of Adelaide.
Okay.
So down near Aldinga Beach.
Okay.
A bit more of a sort of lifestyle location, but still commutable back to Adelaide. And there's a lot going on down there in terms of the town centre upgrade. And again, that was in an area that's got potential for townhouses down the track.
So the place you bought, you can knock it down and put townhouses on it?
Yep.
Okay. So you had to go through the whole process of understanding council requirements around development now and into the future, the right size block, right frontage
That's
size.
right, yeah.
And you spoke about mentorship through this. So did you have someone sort of looking over your shoulder the whole way through these 4 purchases, or someone that you could
someone you could bounce ideas off, and they won't tell you yes or no to go into property. It's more about bouncing it off, and is this a good thing or a bad thing, and making sure you've done the research and you've done the process as part of that decision. And
so the way in which you did the back end of your portfolio is very different than the front end of your portfolio. So the front end was very much, Manly Vale's good. I've got a place here, I'll buy another place there, through to a lot more sort of analytically orientated process where you were given some research, some core fundamentals, which are the growth drivers for property and why should I invest in property. And I know Margaret talks about those a lot, and they're very good and they're very common sense based stuff. So you've gone out there and used those as a blueprint to identify locations, properties, etc. for growth. So out of the last 4 that you've bought, do you think you've got all 4 of them right, or any of them a lemon, or you're not particularly happy with?
No, all of them I'm really happy with so far. It's obviously nearly been 2 years now, and they've been fully tenanted since we got them.
Okay.
A couple of maintenance bits here and there, but as expected. They've probably seen some growth since we bought them, which is good, so a bit of an uplift. So we can hopefully revalue those down the track and pull some more equity out to go again.
And that's the idea. So you're just going to just wait for growth, draw some equity. So your place up in French's Forest, your PPR.
Mhm.
Is that principal and interest? Are you paying down?
Yep.
Okay. But all the other stuff is just
It's
interest
all
only?
interest only. Yeah.
Okay. And did you receive any advice around that? That sort of process of actually driving down the principal component on your PPR?
Yeah,
Yeah.
definitely. With our accountant as well. So she helped us in that structuring field and just how to set up the loans.
Okay.
And while ever you've got non-deductible debt on a PPR, it's obviously the best idea to try and reduce that down before you start tackling the principal on any investments.
And Phil, you just mentioned to Michael that his portfolio is almost sort of in two parts. There was that first part and then the second part where you went quite hard. How did you make the adjustment from, you admitted that you bought in Manly Vale because you knew it and you lived there, to then you're sort of going to the fringes of Adelaide and up in Queensland? How did you make that mental adjustment? Because I think that's something that quite a few investors struggle with. If it's not in their backyard, they just can't do it even if they know they should. So, and it sounds like you started out a bit like that. How did you make the jump to being, I guess, what we'd term a more sort of sophisticated investor, but it is also more risky because you don't really know what you're getting?
Yeah, I think it's just understanding the fundamentals of the area. So you've done all the research on the micro stuff, and then you get down to the macro, understand the property type and the area that it's in, and then leverage help on the ground in those areas. Using a really good property manager that comes on a recommendation, and use them to look at the properties for you and get advice that way. And then obviously getting a building and pest inspection done to really cover off that risk that the property's not a lemon. And I think once you've covered all of those bases and the yield is right, the demographics is right, then you've gone a long way to reducing your risk.
You've stepped inside all these properties yourself?
No.
Okay.
So those last ones were all sight unseen.
Okay.
So it's very different.
Are you okay with that?
Yeah, no,
Yeah?
absolutely. Yeah, once we got over that hurdle, I think it was easy to do.
So what next?
So a bit of consolidation at the moment. So reduce debt. So saving hard to reduce down the principal on our PPR.
Okay. So you'll draw down on your PPR. So are you going to use that as a cash cow?
Yeah, so we're obviously reducing the principal on that, and we'll pull out more equity from that when we can do,
Okay.
and then go again. So maybe second half of next year. The plan is to go again. So the target is a portfolio of around 10 properties. It's more about a value than a number. So the target, we'd love to get to 8 million if we could in sort of 15 years time, and try and bring the debt down to around 4.
So you'll buy and wait for these things to go up in value. I'll simplify this at a period of time, 15 years time, and then reduce the debt. And you reduce the debt by either getting a massive windfall and chucking a whole bunch of cash in there, or selling off parts of them, ending up with a number of properties unencumbered. So that number for you of unencumbered properties that just deliver you a yearly income, what is that number?
The yield, I don't know off the top of my head, but the unencumbered,
unencumbered.
Of say 4 million, if we were to sell everything, is a passive income of about 200,000 if you were to invest that in something giving you an interest return. That's the exit strategy now. I think it might change when we get closer to the time.
It won't be 4 million. It'll be like, it's funny how people's paradigm changes as they get more and more properties, and they think a couple $100K is a passive income upon retirement, inverted commas, versus you know what, I think maybe we might need 300 or 400 or whatever. So it's good to see how that journey changes.
That's right.
But,
I think it's setting the plan now, having something to aim for. If you know what your goal is, you can work out how to get there.
And then you can always increase it.
Yeah,
absolutely. I think it's the diligence. It's the ability to be able to set a plan and follow it. And it's okay for your plan to evolve and change over time, but it's the planning part is the important part. So if you can start early investing in property by planning, then you can evolve your plan. As long as you're still planning, it's okay. So it's a really good point. We've got to wrap up.
Yeah, we do. Always run out of time.
We do. It's like property just keeps happening. Thanks, Michael. Appreciate it.
Pleasure.
Yeah, really good to have you on. A couple of things I take from this conversation is the value of education. Probably the major thing. The fact that you've gone out and you've invested in your education, and you've invested in the right type of education, I think, as well. So if education actually empowers you to make more effective property investment decisions. The other stuff that you want, there's a lot of bad education out there, and that sort of education is how to buy an off-plan apartment with some guy who's selling it to you. So be wary of those type of things. Understand the sort of education you're getting and what you hope to receive from that education. First point. And I guess the second point is that stuff changes. You know, what you're doing today as a property investor won't be like what you're doing in 2, 3, 4 years' time. And that evolution's a good thing as long as the evolution's sort of going forward rather than backwards. So, let's get you back in. Once you get some more stuff.
Yeah, when we're on to the next one.
How you're going. I like the idea how you purchased a principal place of residence that also had an investment component with it. So obviously there's tax implications with that.
Yep.
You've got to declare that as income and all that sort of stuff. But it's a smart way to do it. I've got a good mate of mine who bought in French's Forest, did exactly the same thing. He's got his house up top and he's like a 1-bedroom apartment downstairs that pays for a lot of his mortgage.
Yeah,
so
it's a smart thing to do.
Very smart thing to do. Nice one. Thanks, Michael.
Thank you.
Remember to tune in next week, the Smart Property Investment Show. You can also check us out online, smartpropertyinvestment.com.au. You can follow me on Twitter at Philip Tarrance. You can find Smart Property Investment on all the social stuff as well. Please keep keeping those reviews coming. They're
only if they're positive.
Fit and fast. Yeah, positive reviews, please. 5 stars. But if you've got any feedback for us, anything you'd like to see or not hear about, we're really keen to understand how you guys are engaging with the podcast and what more you'd like. So email us at editor@smartpropertyinvestment.com.au.
And I will eventually get back to you.
And Viv will get back to you. Yeah, thank you. Appreciate you tuning in. We'll see you next week. Bye.